Welcome to the EACC Spring EU Economic Update, Springtime in Europe, the return of growth and prospects for the year ahead. This event is organized by the European American Chamber of Commerce in collaboration with the European Commission. And my name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC NY, and I will be your host and moderator for today's event. My conversation partners include Ben Carlina, he's a senior economist at the EU delegation to the United States, and Dimitrios Rakitsis is back. He's a senior economist at the ECB's representative office in Washington, D.C. Welcome back, everybody.
Thanks, Yvonne. It's great to be here.
Good to have you.
Thanks,
especially if we have something positive to talk about. First quarter growth proved better than expected in Europe, and both the Euro area and Europe as a whole. GDP expanded by 0.3% as Germany returned to growth, and Spain, Ireland, and the Baltics, among others, reported strong expansion. All good developments following 2023, when it was a little bit more challenging. In terms of we get into some of where the headwinds are coming from and what some of the issues are in a minute, but I want to make sure that we also cover the transatlantic developments, divergence between Europe and the US. We saw in 23, it's already closing. We're closing in on the US, and the first 3 months of the year, the difference was US 0.4% and US 0.4%, EU 0.3%. Where are we going? Ben, could you give us a quick overview of the developments in the EU and to get us started?
Sure. As you said, 2023 was a challenging year for Europe, even as we saw, some really surprising economic performance in the United States. But Europe, of course, was still working through the issues stemming from Russia's invasion of Ukraine and the commodity price shock. But this year, in the first quarter, we got some really encouraging numbers. And, the hope and the feeling is that the EU economy has really turned the corner, and momentum is expected to gather pace over the next 2 years. That's one of the key messages from the Commission spring forecast that came out last week. And, really the key reasons are that despite the weaker than expected and weaker than hoped for growth that we saw last year, the labor market has remained strong throughout in Europe. And now you've got a situation where, with strong employment growth and falling inflation, you've got rising real incomes, and that should help support domestic consumption and get households out there and buying stuff. And that's going to, be the major impetus behind the rising growth that we're seeing. So just in broad terms, just about every EU country should see growth return in 2024. But of course, that always masks differences between European countries. So some of the risks and the challenges that we should highlight is that there continues to be weak external demand for many European exports. And that, combined with still high electricity prices and some increasing competitions in some of the major industrial sectors, this is a challenge for the European manufacturing sector, and this has been where a lot of the weakness has been. And on the other hand, I already mentioned that real incomes are growing and the consumption should pick up, and we've also got some good trends in terms of public investment, where countries are benefiting from money that's flowing from the Recovery and Resilience Fund. And we've also seen this shift away from goods purchases towards households buying more services. And in particular, a lot of European countries have benefited from this boom in tourism. But over the longer term, of course, the key to increasing wealth and living standards is always productivity growth. And so that's why it's really key that the RRF is a success, and that you see these ongoing investments in the green and digital transition that works together with the structural reforms that all these countries have agreed to make. And hopefully that's going to unleash animal spirits and spur innovation and continued growth over the coming years.
Let me jump in there for a second. I mean, when we had this conversation in the lead up to this event, can we really expect constant, never-ending growth? Or is that just in itself delusional, the aspiration? I don't know, Dimi, if you want to comment in as well. But Ben, if you want to go first.
Okay, I'll go first. So, I mean, so first of all, I just want to highlight that like there is a lot of high scale innovation that's happening in Europe, and one of the things that has been in the news a lot recently that I'm sure a lot of your listeners are aware of is Novo Nordisk in Denmark. This is a company that has had a couple blockbuster drugs for diabetes and obesity treatments come out recently. Sales are way up, and Novo Nordisk is now the most valuable company in Europe with a market cap that exceeds Denmark's GDP. So there's lots of stuff like this that's happening all the time. It's not all the Magnificent Seven in the United States. There's a lot of high tech in Europe. But it's also, I think, worth mentioning that a lot of the so-called peripheral economies that were at the center of the sovereign debt crisis that we saw a decade ago, it's amazing, but like Greece, Italy, Portugal, and Spain, they've all been outperforming the core European economies recently. And on the one hand, these countries all benefit from the boom in tourism. But it's also a testament to the fact that they really did clean up their financial sectors and make some tough structural reforms, and their underlying economies have a bit more potential and a bit more are on better footing. Equity markets in these countries have done really well over the past year. They've had very good reforms, very good equity performance. And they're also being supported by the RRF money that I already mentioned. About 225 billion euros have already been dispersed. But one of the reasons that we're feeling optimistic over the next couple of years about public investment is that there's 425 billion euros still to come, and the disbursements are expected to pick up speed over the next couple of years. These investments alone are expected to add about 0.5 percentage point of GDP for the EU as a whole. But in many of these countries, particularly the countries I just mentioned, the boost to growth is going to be even higher. And so that's a benefit. And then I also just want to quickly note, because it was in the forecast that just came out, is that this year marks the 20th anniversary of the expansion of the EU into Eastern Europe. And this has really, when we look back, been one of the great success stories of the EU. Not just in terms of like bringing, spreading democracy and these sorts of things into Eastern Europe after the wall came down, but, real incomes in these new EU member states, 20 years ago, they were about 45% of the EU average, and now they're approaching 80%. So this has been, evidence of how joining the single market, it doesn't just have benefits, but it has forced these countries to like meet standards on institutional governance and property rights and fiscal sustainability and things. And all this gave outside investors comfort that these countries were like putting in place the right things that were going to promote growth. And so they attracted foreign direct investment and new technologies that help boost productivity and wealth, which, as you mentioned, these are the keys to wealth, but can we really expect growth to continue forever? So let me stop and see if Dimi wants to weigh in.
Yeah, thanks, Bon. Thanks, Ben. I mean, you both covered the European growth background and the success stories quite well. So I thought it might be interesting to also maybe just zoom out a little bit of Europe now and approach the prospects for, as you call it, constant, never-ending growth from a more global perspective. Just maybe also let me add here, if you see me cough sometimes, please ignore it. I'm battling an allergic reaction, and Washington is not a good place right now for that. So on growth prospects, there's very recent, very insightful IMF analysis And for those interested, that's chapter 3 of the most recent World Economic Outlook, April 2024, on the slowdown in medium-term growth and prospects ahead. So in short, looking backwards, the key finding of this analysis is that the consistent downward revisions in global medium-term growth prospects over the past, say, 20 years reflect a downward trend in actual global growth, largely because of total factor productivity, TFP economists call it, growth dynamics. And let me perhaps elaborate a little bit more into this in detail, along a few angles. So first big message is that it's not like one rainy day. And for those living in DC, I mean, the past 2 weeks of rain, I could add, it's not that in one rainy day, growth prospects grew dim as a result of weather conditions. The decline in medium-term growth projections has been widespread, reflecting secular forces at play rather than forecaster pessimism, my reference to rain. Without risking, of course, boring our audience, I think it may be useful to still highlight that the analysis pins down the successive downward revisions to growth to a few factors. Rising misallocation of capital and labor, persistent structural frictions in the economy, as well as demographic pressures weighing on labor supply. Second bigger message is this is not a European rich versus poor, north versus south, east versus west story. Expectations for medium-term growth have been revised down across all regions and income groups globally. Now, the slowdown trend actually starts in the 2000s, in the early 2000s in vast economies, and then precipitated after the 2008 global financial crisis into emerging markets, pretty much in line with the globalization cycle. So one has to wonder, I mean, looking ahead, where's growth heading, right? So in this analysis, the baseline scenario has assumes that global growth over the next, say, 7-8 years, or what we call the medium term, say until 2030, could be as low as 3% on average, compared to 3.8% between 2000 and 2020. It might sound like a little, but if you think that this is global GDP we're talking about, this is quite a large number. And inevitably, then the question turns to, well, what can be done to reverse this tide, right? So a message that will probably resonate for Europe, as well as the rest of the world alike, is that the future holds both tailwinds and headwinds. So tailwinds would probably emerge from a few factors, the adoption of policies to increase labor force participation, a migration boost to labor supply in advanced economies, a big issue, structural reforms to improve allocative efficiency for capital, improved talent allocation in emerging markets, and the much discussed possibilities to harness artificial intelligence technology, to the benefit of productivity. Headwinds, on the other hand, include the legacy of high public debt, which is still with us and worse after the pandemic, as well as geoeconomic fragmentation, also a big topical issue. So needless to say that the conclusion of the chapter is as sobering as it is relevant, meaning bold and careful policy design is needed to structurally lift growth. And I hate to be the perceived as the Cassandra, as a Greek, or as the bearer of bad news, but maybe with right policies, bad news can be averted.
Yeah, interesting. And thank you for putting it into the global context for us. I mean, when I was looking at the Euro area growth, GDP growth forecast in 25, it's 1.4%, and for the entire EU, 1.6. So I guess we will be halfway there. I mean, what I think is great is that, newer European countries are jumping onto the locomotive. And I mean, it's been really interesting. I had a call from a member, and it was a technology a call. They were looking for a particular solution in the healthcare sector. And it was really interesting where the solutions came from, not from the countries I expected them to come from. So they weren't the first ones, like Germany and France weren't the first ones that got back to me. It was Eastern European countries and Southern European countries, which I thought was really interesting. I want to dive in a little bit more into the unemployment. Are we still worried? I mean, Dimi already mentioned the labor force participation, migration, bringing migration into the talent pool. There are training issues that are hitting especially advanced countries like Germany. I think it's similar in France, although I don't have the exact numbers on this. But where are your concerns, if you have any? And Ben, do you want to start on that?
Sure. I mean, the good news is that some of the upside risks and tailwinds, possible tailwinds that Dimi mentioned, have already been occurring in Europe over the past year. So it's actually quite good news. Despite this, weakness that we had in terms of GDP growth last year, the labor market in Europe never wavered. We've had a strong labor market in Europe for the past couple of years, and the bottom line is that, like, Europe works. Europe created 2 million jobs last year alone, and there was a bunch of reasons why. I mean, apart from the fact that demand for labor was strong, I want to just highlight that the supply of labor also increased in ways that Dimi was mentioning about. A lot of people got pulled back into the labor force not from being unemployed, but from not being attached to the labor force at all. You've had a lot of migration into Europe over the past couple of years, particularly, very large refugee flows from Ukraine, but not only there. And the number of migrants that are being quickly integrated into the labor force is also near all-time highs. So these are things that are going to boost potential growth over the long run, because, as we all know, there is a really serious aging demographic trend in Europe that is going to eventually, reduce the size of the labor force and be a constraint. So, just to give you some numbers, the unemployment rate across for the EU as a whole was 6.1%, a bit higher in the euro area, 6.6, but both of these numbers are either at or near all-time lows. The Commission is forecasting another 2.5 million new jobs being created through the end of 2025. And so there's been this strong labor market throughout. Now, I don't want to say that this is all good news, because this is clearly a tight labor market, and many firms are actually struggling to hire. And that becomes particularly acute when you're talking about very skilled, very specialized positions. There are labor shortages. And this could weigh on innovation and economic dynamism overall if it continues. It's also one of the reasons why, just mechanically, we've had low productivity growth, because firms have been holding on to workers. And there are some concerns that there has been labor hoarding in Europe, that because of the difficulty in hiring, in finding new people to hire, firms are holding on to workers even though their output has been declining. So this will just mechanically lower productivity growth, which, isn't what you want to see, obviously. And it's also the case that there's, longer term questions about the manufacturing sector, particularly in Europe, because this is one of the sectors that had a tough 2023. And so if you want to take the case of Germany, for example, you have this paradox where there's a very low unemployment rate, but the country's facing, major structural challenges in its manufacturing sector. You have energy-intensive industries that have struggled with high electricity costs. You've got an auto sector, for example, that's got to make the transition to building electric vehicles, and there's these like vast supplier networks of many small and medium-sized firms that make some widget for gasoline-powered engines that are going to have a tough time making the transition to EVs, and this is going to promote some churn in the labor force. But as you said, Germany's responding to this by really expanding its worker retraining programs. They're doing this, it's not all publicly directed. It's in conjunction with, on the one hand, federal and state and local governments, but they're also bringing in companies and labor unions to create these new training and certificate programs. And so that's one thing that they're doing. But all of this is, I think the thing to emphasize is that there's been a really strong labor market for the past couple of years, despite this weakness. Lots of new workers are getting pulled into the labor markets. And so these are sort of, we know what the challenges are and steps are being taken and things are moving in the right direction. But let me see if Dimi wants to come in.
Dimi?
Yeah, thanks so much. I mean, I can only, of course, echo the points that Ben made, but it might be interesting to maybe look a little bit deeper, into like wage dynamics here, because I think it's going to be of interest to your members, as they have hiring challenges to address. And of course, it's difficult to look at wage dynamics in separation from the let's call it the triangle of love here, which is unemployment, inflation, wages. So one has to really put all of this in context. And maybe just let me, I see Yvonne like the metaphor, that's nice. But let me just maybe also, of course, preface what I'm going to say. Whenever I touch on issues like that, I have to forget, and you have to forget that I speak on behalf of the ECB. Please have a disclaimer in place. I express my own views here. So maybe just starting with unemployment and what Ben said. And I mean, indeed, I mean, the unemployment rate in the euro area is at its lowest level, since the start of the euro. And at the same time, I mean, tightness in the labor market continues to just gradually decline, with employers posting fewer vacancies. So Q into wage dynamics, which remain at high levels, but moderating levels in the euro area. And just maybe to add some data, so recent data on, say, compensation per employee or negotiated wages, or the ECB's very own forward-looking wage tracker, seem to support this baseline scenario of gradual wage growth moderation, which, for all ECB purposes, should support the disinflation process. And maybe looking at some data, so very characteristically here, growth in compensation per employee stood at 4.6% in Q4 last year, from 5.1% just a quarter before, and a peak of 5.4% in Q1. So there's this like gradual moderation trend. And firms have actually also partly absorbed the wage pressures over the past year through their profit margins, and are expected to continue doing so in the period ahead. So from an inflation point of view, which is the third element of this triangle, it would be, of course, useful to have further confirmation that wage growth is decelerating as anticipated, and that profit margins continue to absorb, to buffer the pass-through of higher labor cost inflation before one can, let's say, declare victory, right? But at the same time, with a rather robust labor market and low unemployment, it could also be the case that wages may grow at rates that are inconsistent with inflation objectives. For instance, if they were to catch up faster with households' real income losses over the past years than what is currently anticipated or projected. So I think, this is, of course, a very data-driven issue. And at the end of May, more data will become available. For instance, on negotiated wage growth for Q1 this year, which, in our case, could allow the ECB to confirm or not there isn't positive signals. So it's a very developing angle, which of course plays a huge role in terms of unemployment, in terms of hiring decisions, in terms of disinflation.
Yeah. And not only that, it's I mean, like I said, it's a triangle, and you have people need to make decent wages, need to be employed, need to make decent wages to participate in the economy, go on vacation, spend, buy food and all the other items that they need for their daily life. Let's dive a little bit more into the inflation conversation, because I know everybody in the US is super keen hearing everything about making this a conversation about inflation, I should say. So we're down from 6.4 in 23 to 2.7 in 24. That's huge.
Well, in fact, the recent numbers are even better, because that 2.7 number that you just quoted was the Commission's forecast for where inflation should be at the end of the year. But the April outturns we saw, we had HICP inflation falling to 2.4. So the Commission's forecast that we'll get back to target to 2% by the end of 25 might actually be too pessimistic. But I do want to leave most of the inflation conversation to Dimi as the ECB representative here. So I will back off.
Thank you, thank you, Ben. That's quite an honor. So maybe, of course, happy to dive into touch base and dive into the inflation development story quickly. But it might actually be worth to zoom a little bit more into this later and to look at some nuances of the inflation story in more detail. So just maybe starting with the headline story, so inflation in the euro area continues to decline further. And the euro area annual inflation rate, as measured by the Harmonized Index of Consumer Prices and Eurostat, indeed stood at 2.4% in April 2024, stable compared to March. And just a reminder, as mentioned earlier, a year earlier, the same rate was 7%. So that's quite a decline. And useful perhaps to add for context here that the numbers and direction of travel are rather comparable when looking also at the EU as a whole, EU versus euro area. So in the euro area, the overall narrative is one of progress in relation to goods inflation and food inflation in recent months. Most measures of underlying inflation are easy, and wage growth is gradually, as I mentioned earlier, moderating. Firms at the same time absorbing part of the rise in labor costs in their profits. And earlier on, we saw also improvement in energy inflation, although that one can argue is now partly, somewhat reversing, at least in what concerns the oil prices. So the big remaining question out there is services inflation. I think both of you alluded to that earlier. Services inflation has been contributing by far the most for months now to overall inflation. But the latest numbers for April do show a little bit of progress. After standing at 4% for 5 months, I think, in a row, the most recently released numbers for services inflation for April came down to 3.7%. This is progress in terms of bringing inflation down, especially in light of strong existing domestic price pressures. And maybe I can also turn a little bit to the projection outlook. So the latest ECB staff projections from March 2024, just FYI, the next round will be only in June. In that projection outlook, so inflation has been revised down, in particular for 2024, which mainly reflects a lower contribution from energy prices. And ECB staff in March projected inflation, HICP, to average 2.3% in 2024, 2% in 2025, and 1.9% in 2026. Now, excluding energy and food, the relevant inflation projections have also been revised down, trending at pretty much similar levels, 2.6, 2.1, and 2% between 2024 and 2026. Now, the fact that numbers cited earlier in our discussion are considerably more recent, those coming from the spring forecast of the Commission, may to some extent explain headline number differentials between the numbers I presented and those presented in the report. There can also be some assumption-related issues, as oil price assumptions might be different now compared to 2 months ago. But I think the important message here is that overall the levels and the direction of travel are very comparable. So good news, I want to say.
I want to dive in, just not too much, just briefly, into weakness in investment. We have consumer spending, we have corporate spending. Consumers are spending at a consistent level due to the policies that were adopted during the pandemic and after, and then also, what about corporate spending? You're absorbing the wage growth out of your savings. What else are you investing or not investing into as a corporate during those times?
Well, a couple of things. One is that the fact that inflation is coming down now, I don't want to, Dimi has to be careful about what he says about the ECB's monetary policy stance, but the expectation is in markets is that the ECB will start cutting rates this year, probably sometime this summer. And so embedded in the Commission's forecast is an expectation that financial conditions will ease as interest rates come down. And, all things being equal, you would expect that when you have tight financial conditions, that's going to discourage borrowing. And we've seen that there's been, relatively weak demand in Europe, and there's a number of reasons for this. I mean, first of all, I think, we've said this before, but it's worth emphasizing that the Russia's invasion of Ukraine really had a major hit on sentiment, both household and corporate sentiment in Europe, and is probably one of the reasons why demand for loans has been weak, in addition to the fact that financing costs have been higher. You can see this, for example, in the high EU household savings rate, where I think it was 13.5% of household income was saved last year. And that's a historically high number, even for EU countries that have a high propensity to save. So a lot of this is confidence. A lot of this is tighter financial conditions. You probably have a little bit of negative wealth effects playing a role too, in the sense that some home prices have been falling in certain European countries, and you haven't seen, in core European countries, the equity market outperformance that you have seen in the U.S. So all these are things to explain like why demand has been weak, and why demand, particularly for new borrowing, is expected to pick up as financial conditions ease over the course of the year. But I think another thing to say is that wage dynamics, real income growth is expected to continue to be high. Corporate profitability has been okay, and so as you think about the path for monetary policy, the specific timing of it doesn't matter so much, because we know the direction. And granted, if you are, a hedge fund manager or something like that, then the timing and pace of rate cuts matters a lot. But for the economy as a whole, what we know is that financial conditions are likely to ease a little bit more. That's likely to encourage companies to invest. And one final thing I want to say before turning it back over to Dimi is that a big difference between now and 10 years ago is the strength of the European banking sector, because you don't have the same kind of issues with solvency and liquidity that you had 10 years ago. Banks have cleaned up their balance sheets. By most metrics, they have very high asset quality. They have plenty of regulatory capital. The liquidity is out there, and that means that banks are able to lend. The issue has been that not so many companies have been coming to them and asking for loans, and so hopefully that's going to improve as sentiment improves and as financial conditions ease a bit. But let me stop there.
Yeah, I want to dive into that for another minute, because there's, I mean, the European market and the US market, and maybe we can compare the two of them here at this moment for a second. Rate cuts, high rates are really hurting consumers in the United States. And in Europe, the sense that I'm getting, people investing in real estate and going to the bank to get money, high borrowing rates are hurting pretty much, everyone. But consumers seem to have more savings to be able to buffer that. And maybe I'm wrong. It's just a sentiment that I have talking to Europeans and Americans. How does that, if this assessment is correct, how does that affect our way forward?
Why don't I take a quick stab at that first? One I would say is that in the United States, I think the effects of high interest rates on households have really been concentrated on lower income segments of the population. You see this in like rising credit card balances and things like that. And middle class and wealthier people have not really been affected so much. And there's a couple of reasons for that. One is, of course, the strong labor market. But the other is that monetary policy works a little bit differently in the United States versus Europe, because in the US, when you talk about higher income groups, and particularly people who own their own homes, people have had low mortgage rates locked in for a long time. And so they're unaffected by increases in benchmark interest rates, whereas some European countries have floating rate mortgage markets, not all, but in the ones that do, you've seen households suddenly have an increase in their existing borrowing costs, even though they didn't go out and make a new loan. So monetary policy works differently in the US and Europe. Also, the wealth effects for richer people in the US have been higher because home prices have been going up, in part because there's a shortage of homes for sale, but also because the stock markets have been doing so well. And so these wealth effects have been encouraging people to spend in the United States. And in Europe, I think, as I was saying before, it's more an issue of sentiment, and the tighter financial conditions have bit a little bit more. But the trend is a little bit different because in the United States, there is still widely expected to be not a recession, but a slowdown in the pace of economic growth. Whereas in Europe, growth is expected to increase. So the trajectories there are a little bit different.
Yeah, interesting. Thank you for that. Dimi, European area or Euro area monetary policy. You're
Thank you for this question. So I'm fairly confident that both you, my esteemed panelists, as well as our esteemed audience, can appreciate that there's only one person that gets paid to speak on behalf of the ECB. So please do not be surprised if it wouldn't be me today. If I don't sound very innovative what I want to say here, right? So just repeating some messages from the most recent press conference of the ECB on inflation. So the ECB is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. And just maybe touching a bit on expectations, I can perhaps again refer our audience to the most recent ECB language on that front. The Governing Council of the ECB considers that key ECB interest rates are at levels that make a substantial contribution to the ongoing disinflation process. And future monetary policy decisions will ensure that policy rates will stay sufficiently restrictive for as long as necessary. Now, if our updated assessment of the inflation outlook, the dynamics of the underlying inflation and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner, it would then be appropriate to reduce the current level of monetary policy restriction. I think maybe in terms that our audience can probably grasp a bit, in a more tangible manner, I can turn to current market expectations, and current market pricing seems to suggest with a high degree of probability, as Ben alluded to earlier, that this process could start already in June 2024, when the next Governing Council monetary policy meeting takes place. And data from the ECB's very own survey of monetary analysts as of April 2024 indicates expectations for a few more cuts through the end of the year. In any event, as the ECB president has stated time and again, the important thing to remember is that the ECB will continue to follow a data-dependent, I think that's a key word here, data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of monetary policy restriction. And it also is not pre-committing to a specific, particular rate path. That's maybe as regards the euro area, and I think you alluded to maybe, possibly comparing to the US, but let me know if you would like to do this. I can come in at any point in time.
Yes, say a few words about how you see it, because you're analyzing obviously what's happening in the US. How do you see that in comparison? I mean, obviously it's ever so slightly a different baseline that the head of the US Fed is, or the numbers are different that he's working with. But how do the two policy regimens compare with one another?
Yeah, no, I mean, this is a good question, and we often get it asked, but one has to be careful in what parallels and comparisons they make. So let me perhaps explain a bit more in detail here. So why don't I just start out by acknowledging that it would generally not be appropriate for me to comment on other central banks' policies. In this case, I mean the Federal Reserve's monetary policy. It still might be important, though, to recall that the two, the Fed and the ECB, operate and cater to their respective economies, their jurisdictions, so with their very own economic conditions and policy objectives in mind. So that's a key difference here, of course, in how both the inflation and disinflation process is being and will be approached. The Fed, for instance, has a dual mandate: price stability and employment. The ECB's objective is price stability and price stability alone. And we have to determine our monetary policy decisions on the basis of the data that are produced by the euro area, taking, of course, into account the global environment as a key factor. So maybe looking a bit at inflation developments, in the two jurisdictions, a simple comparison can yield some high-level conclusions as to where we stand. First of all, headline inflation is now lower in the euro area. It peaked earlier in the US at 9.1% in June 2022, compared to the euro area, which peaked at 10.6% in October 2022, and declined markedly to stand now at 3.4% in the US, April 2024, versus, and I recall the numbers that Ben mentioned earlier, 2.4 in the euro area. So that's one. Core inflation remains elevated in both jurisdictions, at 3.6% in the US and 2.7% in the euro area, especially because of still high levels of services inflation, a common issue in both jurisdictions. Perhaps one could also add here the particular importance of rent and housing cost inflation for the US, as well as implications from how it's methodologically captured in the relevant metrics with a lag.
Right.
In contrast, this factor does not explain as much in terms of core inflation in the euro area. And a third element one can throw in by way of comparison, wage dynamics remain at high but moderating levels in the euro area, as I mentioned earlier. I think I mentioned that growth in compensation per employee stood at 4.6% in 2023 Q4, while they're subsiding in the US from very high levels, now standing at 4.2% in 2023 Q4. So keep that, but I'm still pretty confident that the audience understands the nature of the inflation episode, despite differences and common themes in the euro area, was different from that in the US. And just maybe to touch on a few elements here, the drivers were different. The fiscal response was different. The consumption patterns by US consumers were of a different nature. Ben also mentioned excess savings, falling into consumption patterns. Investment outcomes were different. So comparing numbers can be one thing. However, drawing conclusions or parallels between the two jurisdictions on that basis might not necessarily be a well-informative idea. So hence why I said at the beginning, it might be warranted to be a little careful when we compare.
Yeah, no, thank you for that.
Just to reiterate that last point, if I may, Dimi was quoting for the US, he was quoting CPI inflation numbers. And as he mentioned, that has a big housing component. Shelter costs make up about a third of the CPI. And that is a big reason why inflation sort of stalled out, why disinflation sort of stalled out in the first quarter. But you can measure US inflation using HICP, which is the measure that the Europeans use. And I think these are March numbers. I haven't updated for April, but in March, headline and core HICP inflation in the US were running at 2.4 and 1.9% respectively. So that gives you a sense of how much of the elevated numbers in the US are coming from shelter costs. And when you're a central bank, you have reasons to look at all of these numbers, but it gives you a sense of what the different dynamics are and what the difference is between what the Fed is looking at and what the ECB is looking at.
Yeah, no, that's interesting. And thank you for the in-depth analysis, because I think we're always tempted to say, why is Christine Lagarde doing something different than Jerome Powell? And why? Because the situation is different. But we have 15 minutes left. Let's dive into the sectors of the economy that are most strong, the ones that are weak, and what that means going forward. Ben, do you want to take that?
Sure. I mean, in general, we talked about this a little bit before, but during the pandemic, you saw this huge move in consumption towards durable goods. And this was one of the reasons why you had this spike in inflation, because the supply chains got messed up and people were buying way more stuff than companies had expected. But then after the pandemic ended, you had this shift away from goods towards more services. And, we've already talked a bit about how there's been this tourism boom in Southern Europe that has really benefited these countries, whereas the manufacturing sector is having some problems, partly because of high energy prices, but also because of this shift away from goods and towards services. And obviously, on top of that, tighter financial conditions and weaker sentiment because of the war. But maybe this is a good time to mention external demand and international trade, because this is something that is really a key risk going forward. There's a lot of concern about. But maybe just to set the stage a little bit in terms of the global economy, global GDP growth was just over 3% in 2023. And it's expected to continue at about that pace in 2024 and then maybe step up a little bit in 25. So in broad terms, like the outlook for global growth is not terrible. Like it's okay. But it's true that in addition to this, consumer consumption shift from goods towards services, there's been this market slowdown in global goods trade since the end of the pandemic. So part of it's explained by the consumption shift. But another factor has been China. And China's had weaker growth than expected. They've got some issues in their housing sector that they need to work through, their real estate sector. This is repressed domestic demand within China. But it's also worth mentioning, I think, the policy response of the Chinese authorities, because they're responding in the traditional way that the Chinese authorities have responded to unexpected economic weakness. They've been promoting public investment in infrastructure, but also in manufacturing capacity. And, this is potentially a problem for the rest of the world, because there's a few sectors, industrial sectors in China that seem to have structural overcapacity. And there's a risk that they try to export their way out of this, that firms have the incentives when they're faced with excess capacity, lower returns on investment, lower profitability, that they try to export their way out. And I think that this is also, accelerated a little bit by some of these geopolitical tensions and the return of, friendshoring and things like this. So I don't want to say that this is all a downside risk, because Europe and the United States, I think, have the potential to benefit from taking steps to make supply chains more resilient and to bring some production closer to home. And I think that this is particularly true for goods that are like high up the value added supply chain, like technology firms and things like this. But it's a risk, and it's something that could be an upside risk or a downside risk, and that policymakers are going to play a key role in over the next couple of years.
That's for sure. We've seen that with, the tariffs that the US is implementing for Chinese EVs and others. Let's talk a little bit about the energy market. What's going on in the European energy market? Have we weaned off the Russian oil or gas? And what are we looking at in the medium and longer term? And also about the LNG terminals. I'm understanding they're full. Can we keep them full?
I mean, disaster has been averted. People right after, you'll recall the winter of 22, people were worried that Europe might not have enough energy to keep everybody's houses warm over the winter, and that there was concerns that the electricity was going to get shut off. Nothing like that happened. There was really an extraordinary response where they created these new LNG import facilities very rapidly, and that combined with reduced consumption from more efficient use of energy really solved the problem. As you said, LNG inventories and storage facilities are I mean, they're not quite at their all-time highs right now, because traditionally they go down over the winter and then you refill over the summer. But folks aren't so worried about that anymore. things seem like they're in good shape in terms of the new infrastructure and the new sources of liquefied natural gas. And some of it's actually come from Europe. I mean, we talked earlier about Denmark and how they were benefiting from a really strong pharmaceutical sector. But Denmark actually reopened some of its offshore gas fields and has become a net exporter of LNG as well. So even in Europe, there's some domestic capacity there. But really the key issue, I think, in terms of going forward is that electricity prices, although they've come way down from their peak, are still a bit higher in Europe than they are in, say, the United States. And this is like a structural competitiveness issue and is one of the reasons why the manufacturing sector has had a relatively tough year, particularly for energy intensive manufacturing sectors. The fact that electricity costs, electricity inputs are just higher than they are in other places is tough, and it's raising some questions about the long-term viability of some facilities and some factories. So this is an issue, but this is also why it's been so key that we have this next generation EU recovery and resilience facility money, because there's a ton of new investment that is flowing into improving energy infrastructure, boosting renewable energies, making Europe more self-sufficient. And this is something that it has to continue, because it's a key thing going forward that is going to determine how competitive the EU economy is and how efficient it is.
Yeah, no, very, very true. Let's go back a little bit to deficit spending and financial or fiscal sustainability. Dimi, do you want to start on that, or Ben, do you want to give us an overview of how budgets are looking across the Eurozone?
Why don't I take this one, given that this is the Commission's remit? So basically, we're coming out of this period of high deficits due to the need to address COVID and then the energy price shock that followed the invasion of Ukraine. And so now that the growth outlook is improving, EU member states are entering this period of fiscal consolidation, where we're expected to see the aggregate budget deficit across the EU fall from about 3.5% last year to about 3% this year, and then 2.8% in 2025. Now, of course, fiscal consolidation is tricky to get right. It's important to get your house in order when times are good, so that you have fiscal capacity for when the tough times come. But you don't want so much austerity that it disrupts the economic recovery. So we are going to see a consolidation that's probably going to be worth about a 50 basis point drag of GDP this year. But a couple reasons that we are confident that this is a good time to do this is that, first of all, energy prices have come down, which is allowing governments to remove the support measures that they put in place. Now these were really expensive, these policy measures that they put in place to cushion businesses and households from the spike in energy costs. But now removing that spending, because energy prices have come down, means that you can have some consolidation without actually damaging purchasing power. Another thing that I'd like to mention is that when you look at debt to GDP levels, this unexpected spike in inflation we had actually wasn't really a bad thing in this specific area. Sovereign debts actually, received kind of a windfall from this inflation spike. Debt to GDP across the EU dropped from 92% in 2020 to about 83% last year, even though there was a lot of deficit spending going on. So I don't want to make too much of this, because this was a one-off and is not going to be repeated again. But basically, the outlook, the forecast is that debt to GDP levels are expected to sort of stabilize at these levels from here and going forward. So a couple good things: falling energy prices, the spike in inflation helped debt to GDP levels. But of course, fiscal consolidation is not positive for growth per se. And there's concerns about doing too much of it. But In addition, we've got the reintroduction of the fiscal rules this year that were suspended during COVID. And this means that countries that continue to run deficits above the 3% limit could face excessive deficit procedures, which is sort of one of the sticks that the Commission has to keep member states' fiscal balances in line. And we won't know until the end of this year if any countries actually enter the EDP, because the Commission hasn't received fiscal year 2025 budgets from our member states yet. That's going to include their medium-term fiscal structural plans, which are important to figuring out whether they're in compliance with the new rules or not. So it's too soon to say, but basically there is this period of consolidation coming, but we don't think that there's going to be anything like the austerity that we saw before. There's reasons to think that with the growth outlook improving, now is the time to sort of help improve the fiscal stance of European countries. And now the ECB can come in with their very hard line.
Once again, the honor falls on me. So I thought maybe I would take a couple of minutes to describe overall financial stability and financial conditions. But seeing as we're running out of time, I can be perhaps very brief and just zoom in a little bit on that fiscal sovereign financing angle. No? So, I mean, the big picture I want to give from the most recent financial stability review of the ECB published just a few days ago is that financial stability conditions have improved in the last 6 months. One of those maybe to mention is that the near-term risk of a deep recession accompanied by rising unemployment, which was a major source of concern 6 months ago, is now much lower from today's perspective. That said, while this inflation is proceeding in parallel, it's still, this shouldn't provide any grounds for complacency. There's a lot out there that can still, tilt the scale to an undesirable outcome. Geopolitical tensions for one, policy uncertainty in a year with a lot of elections and, prominent consequential elections, possible financial market repricing that could, create upheaval in bond pricing. And then there's still real estate firm vulnerabilities. There's pockets of risk related to the non-banking sector. So there's a lot to look out for. Now, there's also fiscal fragilities, and that's where I wanted to quickly zoom in on where we stand on sovereign financing conditions. So, I mean, overall sovereign indebtedness remains above pre-pandemic levels, owing also partly to a transfer of risk from private sector to sovereign balance sheets during the pandemic, as well as during the recent energy crisis and period of high inflation. And just as I speak about inflation, I want to make a small parenthesis, and I don't mean to go rogue here, but maybe to just touch on one of the questions that was posted in the Q&A. Somebody was asking about why Belgium is the odd one out inflation-wise. It is exactly these measures that have been transferred onto, transfer the risk and the burden from private sector to sovereign balance sheets, and the unwinding of these measures that leads Belgium to have, this odd one out inflation outlook in 2024, 2025, I believe it was, not sure which one, but exactly as inflation, as measures are being unwound, inflation will jump up for that reason. Parenthesis closes. And then I can continue perhaps. I mean, overall, though, sovereign financing conditions have improved, as sovereign borrowing costs have benefited from easier financing conditions of late, and in some countries also positive rating actions. However, overall fiscal fundamentals, I guess that's where Ben wants me to throw the line, remain vulnerable to negative growth surprises and fiscal slippage risks. So one should also add here that the interest costs are set to rise further, especially for sovereigns with high short-term refinancing needs, as maturing public debt that might have been issued at very much lower rates now might have to be rolled over at still higher interest rates. So that remains a risk and the call for caution.
Yeah, and we also have a couple of elections coming up, both in Europe, the European elections, but also within Europe. And then, of course, that big bad wolf that's in the room, or is it the bear, with the US elections. I don't know, we don't have enough time to get into geopolitics, but do you have time to talk a little bit about European competitiveness? And in general, and then maybe versus the US, and how we can kind of collaborate on competitiveness together?
I don't know if Ben wants to come in first, but if not, I'll be happy to come in and shoulder some of the burden as he's kindly filled most of the questions today.
If you want to take the first stab, and then maybe I can close with the RRF's efforts on this point.
Cool, very good. So, of course, I mean, competitiveness, productivity gaps, these are issues that are probably quite a bit above our pay grades, at least mine for sure. But they are consequential to Europe's progress, and they're consequential to its true, as I at some point learned at university, ever closer integration. Zooming perhaps a little bit away from the upcoming European, like EU elections, and starting off on a positive note, it's only fair that one should not dismiss the resilience that the EU has shown through the dual shocks of the pandemics and the war, with swift actions taken each time to bolster the European economy, reforming the map, the energy map in Europe, and deploying tools to support the dual transition, green and digital, through the NGEU. And to this, Ben will mention more later. But that said, if one wants to be honest, there's a productivity gap, in this case, say, between the EU and the US, on areas such as information technology or labor productivity. And one of the elements responsible for this is the investment gap. With private investment, at least in the US, having grown almost 3 times as fast compared to Europe since 2011. And on the other hand, public investment, there the ratio is 2-to-1, so pretty significant, again, since 2011. Though this dynamic has started partly reversing since the introduction of the NGEU, which unleashed a lot of investment money in the EU. But looking ahead, and maybe I'll just end on this note when I pass over to Ben, the lesson for European policymakers is clear. We need to deepen the single market, continue supporting public investment and progress in the capital markets union to strengthen private financing options. And there may also be good reasons for Europe to revisit its productivity strategy amid geopolitical shifts and changes in the global industrial policy landscape. Perhaps one can also give the audience some hints, so they can develop their own views. The audience might be interested to look at the report by Enrico Letta on the Capital Markets Union, as well as to keep an eye out for the report by Mario Draghi on European competitiveness around the end of June. And I think both of those touch on topics you just both mentioned. Thanks.
Yeah, no, I concur with everything Dimi said. And just to sort of re-emphasize a couple of those points, next generation EU and the Recovery and Resilience Facility, these are, in large part, their goals are to improve the competitiveness and productivity and sustainable growth of Europe. And I think it's important to talk about how important the RRF is, because this is really the first performance-based funding program that the EU has ever had. And we're about halfway through right now. I said earlier that the distribution of money is set to accelerate over the next couple of years, but it also means that about 75% of the targets and milestones that were planned to be achieved already by the end of 23, about 75% have been fulfilled, because in order to get this grant money, countries have to commit to making very serious structural reforms that in the long run are going to improve potential growth and improve the productivity, hopefully, of these economies. So it's much too soon to say how successful the RRF is going to be, but for now, it's looking like they're really doing a good job. Just for example, about half the increase in public investment over the past 4 years can be attributed to the RRF. The Commission's econometric models expect that the RRF could increase GDP by almost 1.5% by 2026. And this is just the investment flows. It doesn't count any of the structural changes that are happening. So to cite a specific example, Italy, we can already see that RRF-backed investments have supported public investment, even as deficits are falling and growth has been increasing. So in the short run, it's clear that the growth effects of the RRF have been, unambiguously positive. But in truth, we're only going to be able to see how well it's worked over the long run. Are the structural reforms really going to boost potential growth? Are they really going to create lasting productivity gains? We have to come back to see, but it's going to be crucial not only to put the Italian economy on the right trajectory, but also to give European voters across the EU the confidence that the EU has the toolkit and has policy levers that it can pull that are going to address the economic challenges that we always face. I mean, there's always some crisis somewhere. There's always some downside risk somewhere that we have to address. But all the capital markets union, deepening the single market, all the further integration that Dimi mentioned, this is the path forward to boosting growth and productivity. And we need to deliver on the RRF in order to give people confidence that this is the right way to go. Because, after all, you got to win elections to do this stuff. So
Very
I'll
true.
stop. I know that we've gone over already.
Yeah, very true. Just reminds me of a very personal comparison. It's like a ship sailing through the ocean. What you need is a good crew, the right tools, and the right parts, exchange parts on board, and then you can actually do it. And you get to the other side, in one piece, celebrating, and hopefully more happy, advanced, in good spirits. But thank you both, Ben. Dimi, thanks for coming back.
Always a pleasure, and thanks for the
Yeah,
invitation.
really
Thanks
good.
for having us, Yvonne.
Yeah, it's been a pleasure. We will upload the recording of this seminar on our YouTube channel. If any of our audience members would like to revisit or share it with friends and colleagues. And if you're not a member of the EACC yet and you want to see more of programs like this, I encourage you to join and become an active part. And with that, I wish everyone a wonderful Monday. Thank you.
Thanks,
Thank
everyone.
you.
Have a great day.